Hey everybody, this video is for the ACC 204 tax course. Wanted to cover briefly the deduction for qualified business income. Right now we're in chapter 9. Hasn't been too many questions this week, just a couple. But it seems like that this is the most difficult topic this week, this qualified business income. The other items are pretty, they're somewhat complicated, but probably pretty much self-explanatory. We cover this week deductions for self-employed income, that's deductions for and from self-employed individuals' income, and employees, what you can deduct for and from AGI for employees. And there's multiple things: transportation expenses, education expenses, work-related expenses, training, entertainment, travel. But the QBI, the qualified business income deduction, is a newer piece of legislation that was passed. It went along with the new tax legislation that was passed, the Jobs Act in 2018. And it can be quite complicated, but once you get through it, I think you'll see it's pretty straightforward as well. So the deduction for qualified business income is the lesser of 20% of the qualified business income, or 20% of the modified taxable income, just the taxable income. So if you qualify for this business deduction, you're allowed to take the lesser of 20% of qualified business income, or 20% of the taxable income, right? And you're also limited in certain regards to how much you can deduct. The deduction cannot be more than total taxable income. If you do take the lesser of qualified business income or modified taxable income, if the modified taxable income causes the individual to have a lesser deduction, then you're limited to that lesser deduction. But the difference between the QBI and the lesser taxable limited deduction, whatever difference there is, you're allowed to carry forward to future tax years. So just be aware of that. So we have limitations, right? So there's a limitation based on modified taxable income, which we talked about. You're only allowed the lesser of qualified business income or modified taxable income. So there isn't a limitation on the first bullet. The second is there is a phase out for high income taxpayers, which we'll talk about in a minute. And then a third is only certain businesses are allowed. So to be a qualified business, you have to meet a threshold, right? So, so the second and third limitations apply when the taxable income before QBI exceeds certain thresholds. And if the taxable income before QBI exceeds $326,600 for married filing jointly, or $163,300 for single or head of household, if the total income before the deduction exceeds that, then you're going to be limited to bullets 2 and 3, which is the high income taxpayers as a phase out, and then certain types of businesses. We could skip over that. So what is qualified business income? Qualified business income is defined as ordinary income less ordinary deductions that a taxpayer earns from a qualified trade or business. These are pretty much business profits, revenues minus expenses, right? If you are a sole proprietor, if you are a partnership or an S corp, and you have business income, as long as the income has to do with ordinary sales and expenses, ordinary service revenue and expenses, cash receipts, then it's qualified business income. This also does not apply to corporations, so corporations are not included. Is not included there. So qualified business income is that ordinary daily business income. It does not include capital gains or losses, dividends, interest income, investments, and those things are excluded from the QBI. What's a qualified trade or business? So we said if you exceed a certain threshold, there's going to be a phase out test if you're higher per a certain income that we just listed for married and for individuals. In addition, you have to qualify as a certain business. So a qualified trader business, it's kind of a broad base, but it basically, you qualify if you're a sole proprietor, independent contractor, or a non-corporate owner of an S corp. And I'm looking for the non-qualified businesses, which I don't see them here, but there are non-qualified businesses. These non-qualified businesses include certain professional practices. So if you have an accounting firm, I believe a law firm, a dental office. So if you're providing a professional service and you're a high income earner, you're most likely not going to meet the definition of a qualified business. But there are definitely tables you can see in this tax legislation for that. So that's qualified business income. More importantly, I want to show an example. So we have an example in the text. Wrong one. Let's do another share. We have an example in the text. There it is. So we have an example in the textbook, right? In the textbook had the following example. We had a person, Henry, I forget the last name. This is problem 915. We had a person named Henry that was a truck driver, self-employed. So as such, Henry qualifies as a trader business for a qualified business deduction. The income for the year, the adjusted gross income was $61,200. So Henry, the truck driver, does not meet the high income threshold. So bullets 2 and 3, the income limitation and the qualified trader business limitation doesn't apply to Henry because Henry is below that high income threshold, right? However, the first bullet of the slide was you're limited to the lesser, and this is up here, you're limited to the lesser of 20% of qualified business income or 20% of taxable income. So you're limited to the lesser of the two. So here on the right side of the equation, I'm calculating, if I can put this here. On the right side, I'm calculating qualified business income. Qualified business income is simply the income earned by the self-employed person, $61,200 at 20%, because the 20% appears allowable. So that equals a QBI deduction of $12,240. $12,240. So we solved the 20% qualified business income, simply the income multiplied by 20%. We then need to make sure that the qualified business income is if we choose that, is the lesser of qualified business income deduction or the limitation of 20% of taxable income. So to solve for the 20% taxable income, to solve for the 20% taxable income, we take the adjusted gross income. In this problem, it's stated that Henry has a standard deduction of $12,200. So if we take the adjusted gross income minus the standard deduction, we get total taxable income of $49,000. If I want to solve for the 20% of taxable income, I simply take the taxable income multiplied by the 20%, and I get $9,800. So now I get to make the choice between the two to take the qualified business deduction. Now I need to solve between the two to figure out, do I take the qualified business deduction or the 20% of taxable income? The lesser of the two is the 20% of taxable income. So the tax year is 2019. So in 2019, my qualified business income deduction is $9,800. The difference between $9,800, which was the lesser amount, and the total qualified business income deduction that we could have earned. The difference between the two is $2,440, and that amount is going to be a carry forward that we can apply to future income. So this is a brief summary of the qualified business income deduction, section 199A of the code. If you have any questions, please let me know on that, but hopefully this video helped, and I appreciate you checking it out. Thanks a lot, and I will talk to you all shortly.